Greetings, fellow investors. Welcome to Nordic Finans, where we help you realize your financial goals.
So if that's something you find interesting, please invest in the subscribe button and deposit a like on the video. My name is Marcus.
And I'm Lucas, and today we're gonna talk about 3 things to avoid when investing in stocks, how to filter your investing options. And before we get into today's video, I would just like to ask you this. What is the one thing that you would never invest in? What is the one thing that you would stay away from at all costs? Just whatever it is, let us know down in the comments. Okay, let's dive into today's video. 3 things to avoid when investing in stocks. We've already talked about how to find good investments, and now we want to sort out quickly, like whenever we hit a bad one, we just want to get rid of that as quick as possible so we can find the diamonds in the rough. This video is a part of our bigger series, the investment cycle, so if this is the first video you see, I recommend that you watch the previous ones as well. It's good stuff. It's going to help you a lot to start investing.
Yeah, and I think we have a playlist as well.
Yeah. But enough chit-chat, let's dive into it. What we're going to talk about today is bad management, poor company-specific factors. Is the industry, in fact, maybe dying that you want to invest in? Because that's probably not a good idea then to invest in. Is there a competitive advantage, or is there maybe no competitive advantage? Because that's going to be a problem. And then finally, we're going to try to summarize the whole video today and all the concepts we're going to talk about into something that I like to call the castle allegory. And as usual, we're going to quote Warren Buffett. Once again, this is something he talks about a lot, but we're going to try to make it more practical and show you how to incorporate this sort of little story that he usually tends to tell into an actual tool that you can use when investing. Sorry for that. That was a long rant from me and Marcus. Now, do you want to talk a little bit about bad management and how you can spot it?
Yeah, so we've come up with these 3 factors which are like, should we say, key indicators on when it might be a good idea to stay out of an investment opportunity, I think. So in the first videos we sorted out a few good companies, but now we look for these particular factors in the companies we have found and see whether they can check any of these boxes, and if they do, they might not be an investing opportunity for us. So like Lucas said, the first thing is if the company has bad management. And one of the maybe easiest ways to look at this, and this does kind of maybe sometimes tie a little bit in with the dying industry, is that there is unreasonable high dividends considering the circumstances. So what that means is that some companies have very high dividend yields, even though it's public knowledge that the company is not doing so well. Sadly, I don't have an example right now, but I know I have heard of several companies that had higher dividend yields than big banks in the US that are known to have good dividend yields. For instance, JP Morgan Chase and companies like that. So these struggling businesses still have higher dividends than they do. And it's usually a ploy by the management of the company to keep investors in the company, even though it's failing business, so to speak. And by having a high dividend, they hope that people will still keep their shares, because if everybody is starting to sell en masse, the company will quickly lose its value. So this is a ploy by the management often to try to keep investors with a bad investment decision for the long term by having a high dividend yield in the short term. Does that make any sense, Lucas? Or
yeah, no, I think you did a great job. So if you have a small business that probably maybe shouldn't even be giving out any dividend at all, considering the situation they're in, and they still do, and not only do they give out dividend, but they give a lot, that might be a trick to make people buy it, and then they can dump their own shares or whatever.
Yeah, another thing just quickly on the same topic is that it's also a sign that the company is not reinvesting in itself. And particularly for up-and-coming companies, that's not a good sign. You don't want to see that they pay out massive dividends when they could invest into themselves and become bigger instead. And I guess that ties a little bit in with the next point that we also have here on the bad management, which is that the management has like a culture of disrespecting shareholders. Now, this is a little bit vague, so to speak, and we kept it so purposefully, because this could be a multitude of things, but you can basically see it that they don't take any action that enhances share value or equity value, I'd say, for the shareholders. This gets pretty complicated pretty quickly, but usually it can involve taking on extreme amount of debt. And for that matter, the agent problem, I don't know if you're familiar with that one. Lucas. But
No, not entirely, no.
yeah, but that's one major thing, is that basically shareholders and management's decisions are not always aligned, because sometimes management is more concerned about their own bonuses or keeping their own positions than they actually are keeping the share value high, for instance. And that's a fundamental problem in economic theory, is that there might be some discrepancies maybe behind sometimes between the management and the shareholders. And the way to see this could be, for instance, that you find very unclear strategies and unclear statements coming from the management, that they can't really put forward a good action plan, or they seem very hesitant to answer certain questions, or they simply don't have good answers, for instance, how to move their business forward or how to deal with key issues for the company. So if this is something you can find, maybe through going to the investor relations, like we discussed in the circle of competence, and you can't find good statements, or you become a little bit worried about what exactly are they saying, I'd say that this would be a good thing to consider then, that maybe this is not a good investing opportunity.
I'm thinking here as well as sort of a bonus thing, maybe, when it comes to bad management and bad company practices overall. That what about this, that the company and maybe management in particular doesn't really value, or at least how they act, it makes you feel like you're not really valued as a customer. Is this something that could relate to this as well?
Absolutely. I think it ties in with, again, unclear strategies or maybe bad strategies from the management side, that they actively drive customers almost away. That kind of business won't be around for long.
Yeah, this is something you could probably get an idea about pretty quickly if you start looking at reviews and things when it comes to different company products and just the company overall.
Yeah.
So, poor company-specific factors, this heading might be a bit confusing to you, but what we mean by that is that there are several things you can look at when it comes to the company and the company structure itself, and how well it has performed within recent years. And from that you can find specific things to look at. And if these aspects of the company aren't really that favorable, it might be a good reason to stay away from the company for now and not invest. And the first thing we have here, which I think is excellent, is high debt to equity ratio, which just simply means that the company is way over its head. In your opinion, Marcus, if you can answer, this is quite a difficult question, but can you answer this? What's a high debt to equity ratio is basically what I'm trying to ask you.
I would say, from just shooting from the hip, I'd say that anything above 1, to an extent, you should start to maybe pay a little bit more attention to. Everything about 2 starts to get risky. Like, then you really need to know what you're doing when investing. And of course, anything further than that is probably very, very risky.
Yeah, first of all, I totally agree with that answer based from my limited knowledge, which I'm going to admit is limited. But there's also another aspect of this to consider, which is what kind of debt are we talking about? Because there's a huge difference between like a long-term loan from a bank, for example, which you have like a specific amount of time to pay off, and you know like the sums you need to pay off each year, and then short-term, some like different types of short-term loans which can have way higher interest rates. So this is something that's not really just so one-dimensional. But let's move on to the next one. This one is a great one. I use this one all the time already. The PE ratio is high. It's too damn high. AKA it's too expensive. The stock right now is just too expensive, which is going to be like, in your opinion, you're going to have to determine this to some extent yourself. And I think a lot of people might be watching this and not really know what the PE ratio is. So just a quick definition, it's the price to earnings ratio. And we have a video on it, so I'm going to link that. Just to quickly summarize it, it's basically, well, it's kind of what it says, price to earnings. So if you pay $10 for a share, how long is it going to take the share of that company to sort of earn $10 for the company? That's what it is.
Yeah, I just wanted to mention that it might be a good idea to be a bit skeptical with the PE ratio sometimes when you're dealing with software companies or other type of extreme growth companies, then the PE ratio might not be ideal, because generally these companies are losing money currently because they're so heavily reinvesting into themselves that they don't actually make any money at this point. But at least to what we have seen is that some of them can then turn this around and become very big and very profitable in the end. So they have a little bit different than maybe traditional business, which means that the PE ratio should be used with a bit differently, I think, for these companies. Just something to bear in mind.
Yeah, I agree. And if you're wondering what's like a good or a bad PE ratio, based on what Marcus just said, as you can tell, it's not really that simple. But I would have in the back of my head at least that say that the PE ratio is 20. Then what that means is that with the current earnings right now, it's going to take 20 years. So that's maybe not that good unless company is going to grow in the future, which it probably will. So like just that if you have that sort of reality, or that you know the sort of the definition in the back of your head, I think that's going to help you steer away from numbers that are just like, they are going to seem insane to you when you see them, I think.
Okay, so we have another few company specific factors as well that are pretty general, I think. But one is also that if you're, for instance, thinking about investing into a company that is currently not doing so well, which I think a lot of, for instance, value investors try to do. Yeah, they try to find good opportunities and maybe companies that are a little bit down on their luck. Then it's also good to just be aware of how has this company done before? Have they had a history of revival, so to speak, that they have managed to revitalize their business and go back up in value, for instance? Or how is their track record looking, so to speak? This can also tie in with management again and what they have managed to do. Another thing is that I also wrote down is that especially if the P ratio, like Lucas said, is incredibly high and they're not even an industry leader for that matter, they might just be a minor player. That might mean that the stock is currently overvalued, so to speak, which I think could be a relatively common thing, that minor players that might not even get very high market share sometimes get very high PE ratio because an industry, for instance, gets a lot of hype. I know that there are certain industries, but we're not going to mention specific ones. But there are certain industries that it doesn't matter how the company is actually doing because it's just involved in a certain industry. And then they get a really high PE ratio, even though they are not even any kind of market leader or anything like that.
Think the tech bubble in the beginning of the millennia.
Okay, and then finally we have unlike sentiment, but we already talked a little bit about this on the management section. If the company, for instance, have really bad reviews or customers do not seem to appreciate the company or previous shareholders are not happy with their investments, you can usually find this through different, for instance, investing forums. Then it could be a good idea also to be a bit skeptical about the company, especially if, like Lucas said earlier, if the company has a history of not treating its customers very well. Then it might be an indicator that, okay, for now the business might be doing relatively well, but it's not sustainable for the future to drive away customers, so to speak.
Yeah.
So after that, we come to the final point, which is the dying industry or a poor moat. And I think that these are relatively self-evident. For instance, if a company has a really replaceable product, then you have no specific value proposition, you don't have any unique value proposition, then it's really difficult to stay on top of the game, and you need to keep innovating so that you don't lose customers to your competitors. Then as well, the dying industry. I'm always talking about the printing industry here, because I know that industry is not doing so well, and it's because people are moving away a lot from paper because of environmental factors. So that industry might not be so good to invest in right now, because the whole business or the whole industry might to some extent be relatively replaced. I don't think, for instance, the printing industry will be completely replaced, but severely diminished. And this is also something you want to bear in mind. You maybe want to look more into businesses that are strong and will be here as well in the future, and not invest a lot in, for instance, uncertain industry that might be easily replaced, so to speak. And then finally, we also have diminishing returns or ethical problems. The diminishing returns, for instance, is if a company is running the risk of becoming commodified. If you had, for instance, a business that used to have a unique value proposition, that they have a certain product that they could offer, but nobody else. But then now things have changed and there's a lot of competitors offering similar products, that would probably cut into the company's margins. And all of a sudden there's earnings start dropping after time. And generally this might not be a very good idea then if the competition runs too high and the margins become razor thin.
Yes.
Yeah, so that's definitely something to be aware of. And finally, I also have poor ethics, which means think that some industries are not very maybe liked by the public, so to speak, and they might have some ethical issues. I know that a lot of industries are struggling, for instance, with the environment right now, and a lot of customers try to move away from certain industries because of, for instance, environmental factors or ethical factors. I know that a lot of people actually pay a lot of attention to this, and they don't even want to invest into things they deem unethical, so to speak, or unsustainable. And that might be good because this is an increasing trend. So you should be aware of that. A lot of people are moving away from these industries and they try to come up with alternative industries. So you might not want to end up holding the bag, so to speak, if these industries finally see a push that try to leave them altogether. So that's just something to be aware of if you're investing into these kinds of industries.
Now, finally, we can summarize the video using the castle algorithm. And this algorithm we're going to use a lot more in the next video, where we're going to talk about how to actually find a company that you then want to invest in and really nail it down to like the perfect golden 5-star company. But here we have looked at the like flip sides to some extent, at least. And now to pull it all together, imagine a big, beautiful castle, a big, beautiful medieval castle. In it, we have the king, and the king is going to be represented by management. If you have a corrupt king, you have a lazy king, you have an incompetent king, then you're going to have bad management. Doesn't matter how beautiful the castle is. If the king is stupid for long enough, you're going to have problems.
Yeah.
Moving on. We're going to have the castle itself. It's going to be a beautiful, big, beautiful castle. I don't know why I'm sounding a bit like Trump, but I am. And for our example, the financials of the company is mainly going to be the castle. And if the castle is poorly built, meaning that the financials are bad year after year, the whole castle is going to start to crumble. And it doesn't matter how good the king is and how well they do. If the financials don't hold up, they can't get any good profit margin, they can't move product, it's not going to matter. Like the whole castle is going to come tumbling down. Finally, we have something that's easily overlooked, but to some extent it might even be like the most important thing. The moat, which is the beautiful sort of pond thing filled with crocodiles, alligators, and maybe some sharks with like a laser beam swimming around the castle and protecting it. And this is of course going to be how easy is this industry, how easy is this product, this service to replicate. If it's difficult enough, just the fact that you're the only one producing it and no one else can really produce it as well as you or as cheap as you or as easily as you, it's going to give you a great advantage, a competitive advantage. And the wider that moat is, the more sharks with lasers are in that moat, the better you're going to do.
Mm-hmm. Yeah, so if you have a really shallow moat and there's nothing really stopping you, for instance, you have a very weak product that is easily replaceable, or you're even in an industry that is fearing to discontinue or be replaced altogether, then you have a really shallow moat and no real sharks, maybe just some sad fish flopping about.
Okay, but thank you so much everyone. That was our 3 things to avoid when investing in stocks. And if there's anything else that you thought we forgot about or that you always avoid when you invest, please let us know in the comments. It can be a great teaching experience for us as well, because we're still new at this. It's still our first year. Like we're trying to learn as much as we possibly can, but we're newbies. There's no easy way around it. We're newbies.
I think there's always something to learn as well when investing. So anything you have to say, whatever it is, I think it would be really insightful.
With that, please, if you had any value of today's episode, leave a like on the video, subscribe to the channel if you haven't already, and also check out the investment cycle playlist. There you're gonna find all of the videos in the investing series. And I think that all that's left for us to do is wish you guys happy investing.
Happy investing, guys. And look out for those sharks with laser beams.